If you're thinking about buying an investment property in New York City and renting it out for profit, this video is going to save you from a very expensive mistake. Most people assume they know which property type makes the best investment, and most people guess a luxury condo. Some say a brand new development. Almost everyone is wrong, because New York real estate is not just one big market. It is actually 4 completely different asset classes hiding in plain sight: condos, co-ops, multifamily townhouses, and new developments. And each one has completely different rules, completely different returns, and completely different risks. In this video, I'm going to break down all 4. I'm going to show you the verified numbers, the rental yields, the hidden tax traps, and the liquidity risks, so you know exactly which property type fits your specific strategy. I'm going to explain it very simply, but with the exact data the Wall Street analysts use. Let's get into it. Let's start with the most common property type in New York, the co-op. If you're looking for a pure rental investment where you buy a unit and immediately rent it out to a tenant for passive income, stop looking at co-ops right now. Because when you buy a co-op, you're not actually buying real estate. You're buying shares in a corporation that owns the building. And that corporation comes with a board of directors. Almost all co-op boards heavily restrict or completely ban subletting. If they do allow it, it is usually only after you have lived there yourself for 1 or 2 years, and even then they cap it at a few years total. So is a co-op a bad investment? No, it is just a different kind of investment. Co-ops are priced 10 to 30% lower than comparable condos. If you are buying a place to live in yourself for the next 10 years, a co-op is a brilliant wealth preservation play. You get significantly more square footage for your money. You still get the long-term appreciation too, which in Manhattan has historically averaged around 6% per year over the last 25 years. And you get to deduct a portion of your monthly maintenance on your taxes, because that maintenance pays for the building's underlying mortgage and property taxes. Co-ops are terrible for rental income, but excellent for primary residence wealth building and getting the lowest price per square foot. Now we have the resale condo. This is the gold standard for traditional real estate investors. When you buy a condo, you own the actual real estate. You get a deed. And most importantly, you can rent it out on day 1 with virtually no board interference. But you pay a massive premium for that flexibility. Condos make up less than 10% of the housing inventory in the city, which drives their prices up. Let's look at the actual math of a condo investment. In Manhattan, the current rental yield for a condo is typically between 2 and 3%. That means if you buy a $1 million condo in cash, you can expect to net about $20,000 to $30,000 a year after paying your common charges and property taxes. To an investor in Ohio, a 3% yield sounds terrible. But in New York, you're not just playing for cash flow. You're playing for appreciation and leverage. If you put 20% down on that condo, you're using leverage. If the property appreciates at that historical average of 6% a year, your return on your actual cash invested is closer to 20 to 30%. Resale condos are the safest, most liquid asset for investors who want immediate rental income and long-term appreciation, even though their month-to-month cash flow is relatively low. Now let's talk about the shiny object, new development condos. Buying new development is a timing play. If you buy pre-construction, before the building is even finished, you can often secure a unit at a discount. By the time the building opens 2 years later, the market value has already appreciated and you have built equity without doing a thing. But new development comes with massive hidden risks. In New York, the buyer of a new development typically pays the city and state transfer taxes, which adds nearly 2% to your purchase price right out of the gate. Second, the tax trap. Many new developments are sold with tax abatements, programs like the 421A that keeps your property taxes artificially low, sometimes as little as $200 a month. But those abatements expire, and when they do, your taxes can jump to $1,500 to $2,000 a month overnight. And if you plan to sell the unit right before the abatement expires, guess what? Every other investor in the building is trying to do the exact same thing. Suddenly, you're competing against 10 identical units, driving the price down. New development is fantastic if you get in early and understand when to exit, but you must run the math on what the carrying costs will be 10 years from now, not just today. Finally, we arrive at the smartest investment in New York City real estate, the 2 to 4 family townhouse. If you want to build generational wealth, this is the cheat code, and it comes down to 2 things: leverage and tax class. First, the leverage. If you buy a 3-family townhouse and live in one of the units, you can qualify for an owner-occupied residential mortgage. That means instead of putting down 20 or 25% like a standard investor, you can often put down as little as 5 to 10%. And you can use the projected rental income from the other 2 units to help you qualify for the loan. Second, the tax class. In New York City, 1 to 3 family homes fall into tax class 1. This is the holy grail of property taxes. Under class 1, the city assesses your property at only 6% of its market value. Let me show you why that matters. If you buy a $2 million condo, your property taxes might be $2,500 a month. But if you buy a $2 million townhouse, your property taxes might be $600 a month. You get the massive appreciation and you get a cap rate closer to 5 or 6%, which is double what a condo yields. And your tenants are literally paying off your mortgage while your taxes are staying incredibly low. There is one more advantage that almost nobody talks about. Because you live in the building, New York law gives you owner occupancy rights. If your family grows, if a parent needs to move in, or if you simply need the unit back, you have a legal pathway to reclaim it. That is something you do not have in a condo, you do not have in a co-op, and you certainly do not have in a new development. The building is yours, and the law treats it that way. You can imagine how it can save you from headache with tenants. The owner-occupied multifamily townhouse is the single most mathematically advantageous real estate investment in New York City. But let me be clear about each property type for investment. If you want to live in it forever and maximize your square footage, buy a co-op. If you want a pure hands-off rental property with total flexibility, buy a resale condo. If you want pre-construction upside and willing to time the market, buy new development. But if you want to use other people's rent money and the city's best tax loopholes, buy a multifamily townhouse. Real estate investing in New York is not about guessing, it is about doing the math. So if you're looking to buy in New York, reach out. There is a link in the description to this video to book a consultation. If you found value in this video, like it and subscribe, because this is exactly what this channel is about. Not just what's for sale, but how the market actually thinks. I'm Svetlana Grazeva, and I'll see you in the next one.